Hi, this is Michael Bernaski, and this is video 4 in the financial management series of African Mission Healthcare's Train the Trainer courses. So I hope that this is useful to you, and I would welcome any feedback that you can provide directly through YouTube or reach out to me directly. The next topic that we're going to cover is to introduce the key financial statements. And I'll break this up into a couple different pieces so it's a little bit more digestible. But financial statements are very important. And again, this is aimed for non-finance people. I'm not a finance person, but I've spent my career working alongside finance people. And so I look at this a bit more from a consumer's point of view than somebody who is tasked with preparing and detailed evaluation of these different statements. So we're going to talk about 3 statements, and almost any institution is going to have these statements. Many households have these statements and think about these statements as well. But there are 3 different documents really for different purposes. The first is the income statement, which is really revenue, the amount of money we take in, minus our expenses for a given period of time. And so we might look at last year's income statement, last quarter's, last month's, and look at the money we took in versus the expenses that we incurred during that period. And we'll talk about this in more detail. The balance sheet is meant to be looked at a particular point in time. And so what we're trying to do is, just understand the assets and the liabilities of an institution or a household or a clinic or a hospital at a given point in time. So unlike the income statement, which is kind of for a given period of time, so a year or something like that, or a quarter or a month, the balance statement has a date, and we say this is our balance sheet as of December 31st, 2018 or something like that, and it's meant to list the assets and the liabilities, and we'll talk more about those. The third statement, in many of your cases this will be the most important one, is the cash flow statement, and it's meant to be summarizing the sources and uses of cash. So let's jump in, and we'll cover the income statement first. And let's look at what we've got here. On the left-hand side, we've got the revenue, and the right-hand side, we have the operating expenses of the business. And so I borrowed these from a clinic at Mass Mutual Hospital in Boston. They were publicly available, and so I figured it was okay to share them and use them in this particular training. And you can see these are just high-level categories, but you can imagine there's some rules underneath them about how different things are included in making sure that things are not sort of duly counted or missed. Patient service revenue, they've broken out into inpatient, so of course people who come into the hospital and spend a night. Outpatient, people who are treated at the institution but leave at the end of the day or sometime during the day. And capitation, so per patient per month, fees that they collect from a variety of health plans that they might be involved with ultimately. And then there are some deductions that come right out of patient revenue. Now, these aren't considered expenses, they're considered deductions. And the 2 that we see here are charitable care and then bad debt. So charitable care are patients they agree to see where they have an expectation that they're not going to get paid, or at least not get paid the full amount. And bad debt is something where they kind of expect that they're going to get paid, but ultimately the patient isn't able to pay. And so that $24,000 is deducted directly from revenue and isn't considered an operating expense. And then they add back in other operating revenue. And the example that they use is revenue from a cafeteria. So they have $18,500 coming in from their cafeteria, and that gives a sense of non-patient revenue, but there could certainly be other things in that category as well, like if they had a gift shop or something like that. So the total revenue at this institution is $138,500. Now, the operating expenses are broken out, and these are very common categories that are used. Really, if you look across different industries, even beyond medical institutions, you'd see many of these. But oftentimes, the largest expense is wages that are paid to the employees or potentially contractors of the institution. There are employee benefits. In the U.S., we have pretty generous benefits that aren't wages. You don't get paid them every month, but you get things in lieu of being paid. For example, contributions to your retirement account or things like that. The medical institution needs supplies. Physical space is, of course, important. You've got to work somewhere. Depreciation and amortization, we'll talk about that in a little bit, as well as some other operating expenses. And one thing you'll see that's very common is an other category on lots of financial statements. And depending on the size of the figure that's next to it, I sometimes read into the details that are provided about other, but sometimes I just ignore it. So 2,500 out of 135,000 is pretty small. I probably in this case would ignore it if I was consuming or reading a financial statement. But if I worked at this institution, I might look at it much more closely. And then there's an income or loss calculation from operations. So starting with 138,500, I subtract out the 135,065 of operating expenses, and that gives me an income of 3,435 from operations. So that is just the patient service revenue minus the deductions to the patient service revenue, plus the operating revenue from other sources. Subtracting out the operating expenses is what gets me 3,435. In this particular case, they're adding back in some non-operating gains, and that's 8,500, which they're getting from gifts from donors or investment returns. For example, they may have some rental properties and they receive rent from those and have operating gains from those. And then the excess of revenue over expenses is 11,935. So that's an example of an income statement, but let's talk about some of the key concepts of an income statement. So depreciation refers to the accounting for the use of an asset over its useful life. So let's say your clinic or hospital acquires a particular good, let's say an anesthesia machine or something like that, and you have to pay a certain amount of money up front for it, but it's expected to last 3 or 4 years or 5 or 10 years or 10 or 15 years, something like that. Well, you want to be able to charge the cost of that machine, which would be really high up front, over a longer period of time, because you don't want it to distort the health of the hospital, the view that the income statement gives of the health of the hospital, by making it all show as if it was paid for in the first period of time. And so depreciation allows us to charge our income statement lesser amounts over a longer period of time and smooth out some of the impact of large investments or capital investments. Similarly, there's this concept of amortization, right, which means spreading the lump sum over a period of time in which it is utilized or earned. So if we receive a capitation for a population of 250 shillings for 1,000 people in January, we don't want to, basically show all that income in January. We want to amortize it over the course of the full year that it's intended to cover. And spread that out so that we have a more accurate timing of income and expenses in our financial statements. So both depreciation and amortization have to do with the timing of the occurrence of both income and expense, and it's pretty important. And we also could amortize loans that the business would have and things like that as well. So those are having to do with the timing. When possible, we try to align them to make the information more useful. Sometimes we can't do that very effectively, and we want to time them in terms of when they're consumed. So if I came into your clinic today and you had to use a Band-Aid for me, we'd want the cost of that Band-Aid to be in this month's financial statements. But being able to include other things like how much electricity I consumed when I was sitting inside your clinic, that we have to do on somewhat of an algorithmic basis. And that's why the income statement is an approximation. It's meant to give you a sense of how the business is doing ultimately.